Supply and demand movements' impact on stocks is one of the hardest things for people to understand. They operate very differently. We all know from the days we took economics in school that prices of things are supposed to be impacted and driven by shifts in supply and demand. But those little curves that they drew you in school aren't the way they work in capital markets. Capital markets are nonlinear, and there's a lot of funny little qualities, but let me just take a second. Demand is about eagerness to own, and that's about humanness. And demand bounces around within a fairly tight bandwidth pretty rapidly. People move from being very optimistic to pessimistic, back and forth pretty quickly. News shakes them, feelings shake them, the flu shakes them. When we all get too optimistic or too pessimistic, either one, for too long, we fatigue at that because it takes energy to get away from our normal levels of optimism or pessimism, and then we tend to revert back to the mean. So there's this relatively rapid moving thing that moves too high, too low, bounces around, and pushes prices in the short term off of any reason, no reason, crazy reasons. Supply is this other thing that's in the long term more powerful and more linked to economics. And when it's in the company's interest to buy back stock and destroy it because that increases their earnings per share, they'll do that. When it's in companies' interests to create new stock supply, they'll do that. But it takes longer because there's a regulatory process and there's a marketing process. They're not sure they'll succeed. So they get more eager to create supply, but that eagerness has to be extended over a longer time period. In the long term, supply can overwhelm any demand because demand bounces around on a fairly tight bandwidth, but rapidly. Supply moves slowly, but nearly infinitely. It can overwhelm any amount of demand, whether it's overly high demand or overly low demand. So in the short term, demand impacts what happens to stock wiggles. In the long term, it's supply. This is very parallel to Warren Buffett's famous line that in the short term, stocks are a voting machine, sentiment, and in the long term, they're a weighing machine, supply. So when you think about stocks movements in the short term, think demand. When you think about them in the long term, think supply.